Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Monday the 18th of September. I have the latest business and finance news from across Asia for you. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In the latest news, China's retail sales and industrial production grew faster than expected in August. Retail sales grew by 4.6% from a year ago, beating expectations for 3% growth. The increase was also faster than the 2.5% year-on-year pace in July. Industrial production also accelerated, rising by 4.5% in August from a year ago, better than the 3.9% forecast and faster than the 3.7% increase reported for July. The official data showed property investment and residential sales remained weak. Property investment decreased at an 8.8% year-on-year pace in the January to August period, worse than the 8.5% decline up to July, although not as bad as the market was expecting. China's new home prices dropped at a faster pace in August. New home prices in 70 cities declined 0.3% last month from July. That's the biggest fall in 10 months. China's central bank released more cash into financial markets Friday to support the country's growth momentum. The People's Bank of China added a net 191 billion yuan, that's just over $26 billion into the banking system via a one-year medium-term lending facility. The PBOC kept the MLF borrowing cost unchanged at 2.5% after a surprise 15 basis point cut last month. However, the PBOC cut the rate on a 14-day reverse repo by 20 basis points to 1.95%. Members of the United Auto Workers have gone on strike at key assembly plants in the United States for the first time ever after failed talks between the union and the so-called Big Three major car makers on a new labour contract. The walkouts, which have seen 12,700 workers taking to the picket lines, have hit factories owned by General Motors, Ford Motor and Jeep maker Stellantis. When combined, Ford, GM and Stellantis account for roughly half of the 15 million cars produced in the US each year, and some economists are worried about a broader impact on the American economy from the strikes. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and the Shah, Asia Chief Economist at BBVA. Providing a view from Mainland China will be Shanghai-based independent economist Andy Sher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, and do please take a look at my daily newsletter, which you'll find there.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
The tech sector dragged shares on Wall Street lower on Friday. The S&P 500 and Nasdaq fell for the second week in a row, while the Dow clung to unchanged over the 5 sessions. The S&P 500 was lower by 1.2% at 4,450, sending it to a weekly loss of 0.2%. The Dow slid 289 points, or by 0.8% to 34,618. At its lows, the index completely wiped out Thursday's 332-point rally, and for the week it was up 0.1%. The Nasdaq Composite dropped 1.6% to 13,708. It was lower by 0.4% over the week. Shares of ARM Holdings were lower by 4.5% one day after its successful public debut. Fresh data last week did little to change the view that the US economy will remain strong, keeping Treasury yields high. The 2-year yield closed back above the key 5% level, rising 5 basis points over the week to 5.04%. The 10-year yield added 8 basis points to 4.34%. The US dollar index recorded its 9th straight weekly gain for the first time since October 2014. The renminbi hit a 2-week high against the US dollar after stronger than expected China economic data. The onshore renminbi rose 0.9% last week to 7.2466 per dollar. Oil prices gained for a third consecutive week and for the 10th week out of the last 12. Brent crude oil traded 0.2% higher at $93.93 a barrel for a weekly gain of 3.6%. Hong Kong's Hang Seng Index rebounded from losses in the final hour of trading Friday to close 135 points, or 0.8% higher at 18,183, and for the week it was 0.1% lower. The Hang Seng Tech Index rose 0.5%, reducing its weekly losses to 0.3%. The Shanghai Composite dropped 1/3% to 3,118, leaving it flat over the week. And this morning, the Hang Seng is projected to open around 130 points or 0.7% lower at around 18,050. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's the start of a new week, and as always on a Monday, we welcome Alex Wong, Director of Alex KY Wong Asset Management. Morning, Alex.
Good morning, Peter.
And also joining us is Lashar, Asia Chief Economist from BBVA. Morning, Shark.
Morning, Peter.
Let's start with the China economic activity data, which showed a pickup in most areas apart from things related to property. China's retail sales and industrial production grew faster than expected in August as policymakers expanded their support measures. But data related to the property market showed the downturn in the sector worsening, according to the National Bureau of Statistics. Retail sales grew by 4.6% in August from a year ago, beating expectations for 3% growth, and that was also faster than the 2.5% year-on-year pace in July. Industrial production also accelerated, rising by 4.5% in August from a year ago. That was also better than forecasts and better than the 3.7% increase in July. The data did show, though, that industrial activity has favoured state rather than private firms. Industrial value added output increased 5.2% year-on-year at state-owned enterprises, but only 3.4% year-on-year at private companies. So, Shark, let's get your assessment first of all of what you think of this economic data. Do you see positive signs there that maybe things are improving?
I think this one shows some very good signs to Chinese economy because last month in July we see very bad data outturns, especially this industry production things, this retail sales things. They all fall to very low level. But this time we see the rebound. I think we can see that the economy is still on the right track. Okay, of course we need to take into account consideration that the authority, they have done a lot of things to try to stabilize the economy, try to boost the domestic demand. But anyway, it looks the August data is still in line with what we have seen before July. That means this year they are going to have this recovery, but not as good as many people expected, but not as bad as shown in the July data. So
I think if you go back to the beginning of the year when people were looking forward to this year, they really thought there was going to be quite an extraordinary rebound, didn't they, after the COVID restrictions were lifted?
Yeah, exactly. I think even compared to the beginning of the year, now the real data is weaker than people expected.
But I suppose that's where we should also be careful, couldn't we? When we compare year on year, we're comparing this with a period where a lot of China was in lockdown and activity was shut down. So it's difficult to make those year on year comparisons.
Sure. That's why they have this 4.6% industry production. Otherwise, I think maybe just around 3%. Yeah.
Alex, are you more optimistic? I mean, there were signs even before this data that maybe things were turning a corner, weren't they, on the inflation data, which we saw, and also on the trade data, which, although negative, was at least better than previous months?
I think we should be still very concerned about the property market in China. I think that part is still in danger. I think it would not be easily recover, and then that probably will affect other things as well. But I think consumption side actually is okay. As I've said, we have seen good box offices and also restaurants and travels are okay. So probably those young people are changing their spending patterns, and industrial production actually is showing some green shoots. I think because people would have thought the global economy is slowing down, so that would affect China as well. So I think part probably is the best part of this set of data.
I suppose if you ignore the property-related data, it's actually all looking pretty good, isn't it? It's just that anything that seems to be related to property seems to be getting worse. Property investment decreased 8.8% year on year. That was worse than July, although maybe not as bad as the market was expecting. That seems to be the real fly in the ointment, but that's presumably a problem because it's such a large part of the economy.
Yeah, then I think it will continue to be the problem for China, because I think it is not easy to recover, and that may affect other things as well. But the good thing is, I think those property related investment are only concentrated on the wealthiest part of China. So I think the ordinary people probably may still spend their money on daily items. So I think that is not affecting too much on consumptions.
Shark, how big a problem is this property sector? How big a drag is it overall on the economy?
Yeah, I think people estimate that property and its related activities account for maybe 1/4 of the total economy. So that means now the property market is in a very bad situation. This one definitely they will drag on the growth. That's why the Chinese authority, they have unveiled a lot of stimulus policy initiatives. But I think I fully agree with Alex. They cannot fix the problem of the property market over the night. I'm afraid this kind of drag from this property sector will continue for at least a few years.
Really? As long as that?
So that's why we see good August data. We shouldn't be too optimistic about that one because this property market is still there. Okay, although even from the property market, we see some good news. For example, this Country Garden, they avoid this default recently. They get some money from somewhere. I don't know. Okay, but anyway, I think that this one they can buy some time, but I don't think they can fully fix the problem. So this problem will continue. Yeah.
The real standout number, I suppose, out of all that data was retail sales, wasn't it? That's the figure that looked pretty good, rising. Where was it? 4.7% was it year on year? I've lost the figure now. But I mean, if we go back to before the pandemic, we regularly used to see 8% growth or more, didn't we, in retail sales? So maybe it's sort of reached a new plateau.
I think we should forget the old numbers. Yeah, in future, I'm afraid this retail sales, industrial production, I don't think they can come back to the level of 7 or 8%, right? 5 to 6% already good enough. Now we have seen, even with the low base of last year, we only see less than 5% in August and in other months. So I think that in future, as I said, with this property market problem continued, so the Chinese economy, they will have a lower growth rate in the next few years.
Alex, what do you make of what the PBOC is doing on the stimulus side? They put more cash into the financial system, but they left the medium-term lending facility rate unchanged, although they did cut the 14-day reverse repo by about 20 basis points. Still looks like it's sort of piecemeal bits and pieces the PBOC is doing.
I think they probably was still take this approach because I think the problem is in the confidence, and also the property sector is not too much related to money supply, I think, and because people actually are spending, I think, and also the investment will actually is not affected too much by the rates. If you cut the rates by a marginal number, then you will not stimulate too much. So I think they probably will still be very cautious in pumping money because they have learned the lesson a decade ago. That is not helping much. I think they need to do something to boost in confidence instead of just putting money in the system.
And I presume they're being cautious about the yuan, that they don't want to see further depreciation of the yuan, so they're taking all these measures to try and support the currency, so they can't really cut rates at the same time.
Yeah, because actually the one short-term interest rate has risen a little bit last week to and that's why the renminbi actually has some rebound. So I think that is a point that they also want to address.
Shark, do you get that there's maybe a bit more sense of urgency now from the PBOC and the government to go and boost growth?
I think that definitely they need to boost the growth, but I agree with Alex. You purely rely on this interest rate, the monetary policy. Maybe the impact will be very limited. So they need to find other ways, including this fiscal policy. We have talked about why don't they just distribute some coupons to
President
people.
Xi Jinping doesn't like that, does he?
Exactly.
He calls it welfareism.
Yes, that's I don't know why, but I'm afraid that they will think this one unnecessary if we see the economy start to stabilize, unfortunately. But anyway, I think that they need to do something. And on the monetary policy side, of course, they are constrained by the exchange rate issues. But at the same time, I think it's right for them to do these piecemeal things. I mean, for the PBOC, they should be show to the market. We try to do something, and we try to boost the economy. Because I traveled in China several months ago. I feel that people they have the feeling that the authority think the economy is no longer the only goal for the government. So that's why they worried. They worried they don't take care of this issue for anymore.
So the economy is not the number one priority for Beijing.
Yeah,
presumably, what is national security, technological development?
People have this feeling. So I think that now the PBOC and other government agencies, they are take some steps. They just try to show to the market that we still we still care about these economy things. I think that's good. Yeah.
Alex, how big a problem is this latest news about Sino-Ocean, another Chinese developer, suspended repayments on all of its offshore borrowings in what it says was a response to mounting liquidity pressures, including a rapid decline in contracted sales? I mean, it sounds like, this is becoming a financial problem as well as a property sector problem.
Well, I think this is... of course, a financial problem because this is related to all the investment related to properties. And I think this is sort of expected because we all know that the sales is slow and they have cash flow problems and they are likely to stretch the payments in a few years' time at least. So I think this is sort of expected. But I think people probably have to address how these problems spreading out to all those asset management products in China.
Shark, what do you make of the RRR cuts that we saw last week?
Yeah, they just try to inject the liquidity to the market. I think that this one come a little bit early than I expected because in August they just cut the LPR and the MLF, but this time they do on the second on the following month they do this RR cut. I don't know whether they are going to cut LPL this month or not. According to the MLF situation, maybe they are not going to cut this month. But I'm afraid that in next month they will do something. So you can see that the authority, they feel the urgency to do something because the July data outers, they scare everyone off.
Okay. Now, Alex, the other thing going on, these Chinese trade disputes, first of all with the EU over electric vehicles, this investigation into subsidies that the EU says China is providing its electric vehicle manufacturers. China's talking about retaliation. The EU is talking about as well, maybe they may see retaliation to this. How big an issue is this, do you think, in terms of, this is a big market, isn't it, for China?
Yeah, of course. But in the meantime, I think market is not expecting too much on this. I think they think this probably would be resolved. So you do not see too much reactions. I think we should not be too concerned at this moment because probably we may have some trade restrictions, but not too much. I think. Yeah.
And presumably this investigation, it will go on for a long time. It could take many years.
Yeah, I think, of course, first of all, that this will take time, and then I think the results may not be expected, I think. Yeah.
But it just does show, doesn't it, just how big now the Chinese EV makers have become. I mean, they're dominating the global market. They're putting a lot of pressure on EU car makers, on UK and US car makers. They really are cleaning up, aren't they?
Yeah, that is the problem for Europe, because the car industry actually is very big and over there, and the emergence of EU EV actually is a threat to them, because they are a bit late in starting that kind of business. So they are lagging behind BYD or even, of course, they are lagging behind Tesla or even BYD. Yeah.
And why is it that the sales are increasing so much for these Chinese car makers? Is it because, as the EU says, that they're receiving subsidies, so they're basically competing on price, or are they making better quality cars than the Europeans and the US?
I think at the cost level, they are much lower than Europe. And then they actually selling at very low margins, because competition is actually very huge in China between the EU EV makers. So the margin are very thin. So that's why they are selling at so low prices.
And is that because, can they do that because they're getting subsidies? Is there truth in what the EU says?
I think that they're getting subsidies from the capital market, not from the not from the governments, because people are treating this business like internet. So they are spending more on the marketing expenses, and they think eventually, if you can eat out those competitors, then you can get back to better margins. So I think they are getting subsidies from capital market instead of governments.
What do you make of this, Shark? How big an issue is it?
I think if you talk about these subsidy things, I would like to say that in the past, the Chinese EV do receive a lot of subsidies from the government. But that's because the government want to encourage this kind of clear energy, right? So if you use EVs, so you don't need to use this gasoline. So that's the Chinese, they want to promote this kind of clean energy things. But now I'm afraid that they receive less and less subsidies from the government. Of course, I personally welcome this prop. I welcome this prop to show that it makes no sense. The Chinese made their things, and the government make subsidies and export to the Europe to subsidize. That means they subsidize the consumer in Europe, right? So,
well, that's exactly what the EU does. It does subsidize the consumer, doesn't it? It doesn't matter whether the subsidy comes to the manufacturer or the consumer, it still lowers the price.
Yeah, exactly. So I think that they need to make this one clean, make everyone knows whether Chinese EVs, they are still receiving the subsidies or not. Okay, and if this prop they prove to be not in favor of China, I think that China should take some corrections. Now the thing is, if you look at the EVs made in China and the EVs made in Europe, the China they enjoy a lot of the advance in cost and even in quality. Even the car makers in Europe they admit this one.
Right. Yeah. But European car makers, US car makers, when it suits them, they subsidize them as well. I mean, look at after the global financial crisis, the US government had to bail out the big American car makers. So, they've all received subsidies at some time or the other by the sounds of it.
Exactly. But, nowadays, sometimes I think they are talking different things. Right, so if the European or the US they subsidize their car makers, they just try to keep jobs for the people. But if the Chinese they export things with subsidies, that means they will take off the jobs from the European and US workers. So yeah, that's their argument.
Okay, well, let's switch our attention to the markets. Alex, I'm interested in getting your thoughts here. First of all, on the US market, we've talked about this several times, the concentration in just, several large stocks. So the latest statistic I have here, the 10 largest companies in the S&P 500, they now make up 34% of the index, and they have an average PE ratio of 50 times. So this is higher now than during 2001, during the dot-com bubble. And even in 2008, the top 10 companies were only about 25% of the index. And these 10 companies now have accounted for about 80% of the Nasdaq's entire rally this year. So we've talked about this before, but it seems to be getting even more concentrated, doesn't it? This market rally that we're seeing at the moment in the US. And I'm wondering, is it heading for disaster?
Oh, I think probably not. I think the overall sentiment in the US is still okay. But I think we probably may see some sector rotation. tech probably may have some retracement, I think, because if you look at the recent developments, we have rising bond yields, and we have at least Adobe and Oracle down a lot after the results. So we are seeing some weakness in certain parts of the tech already, and they actually, I think, are setting up examples. And I think people are probably switching into banks right now, because they probably think the macro backdrop is a soft landing scenario, and yields probably may remain high, and economy is doing fine. So they are buying banks right now. So I think we probably may see banks supporting the whole market. And then we are seeing weakness in the tech sector. So overall, I think the market will not retrace too much.
I mean, what's interesting is that there's still money coming off the sidelines going into the US equity markets. We look at that Bank of America report, the quarterly survey. It showed last week the biggest weekly inflow in about 18 months. So it seems to be that people are getting even more confidence in this sort of soft landing scenario and putting money in the market.
Yeah, because if you look at the bond market, actually it's so weak. So usually we should have some pressure on the equity market as well, but we are not seeing that happening. So people actually are still quite bullish for the U.S. markets. I think probably the help of AI, and also I think they are more confident in the US than other markets as well. So I think that's why I do not expect too much retracement in the US market.
That's the other thing, isn't it? The bond market performance this year, we're on track now for the third loss in a row in US Treasuries. Normally, you would expect by now, after almost 3 years, that would start to impact equities.
Yeah, I think this is kind of strange, because right now we are seeing the weakness in spreading into those long end. So you actually can lock in the long-term interest rate return at a quite good rate right now. So that's what, and we are not seeing too much support in the bond market. We are seeing it edging lower every day. So this is a bit strange in the bond market, and that's why we should be cautious on growth stock right now.
Shark, a lot of this is dependent, of course, upon the US economy having a soft landing. That's basically what investors seem to be betting on in both the bond markets and the stock markets. Are you confident that the US is on track for that soft landing?
Unfortunately, I'm not. Okay, so I'm not very confident that the United States, they can achieve a soft landing, because if you look at history, every time when people have such high expectation, they will make some problem. Yeah. So this time, maybe, of course, it depends how you define you soft landing. If you just define this without any recession and you can get rid of this problem, I'm afraid not. But it is true that this time, you see, if even we have some recession, it shouldn't be that theory as before. So yeah, we can see the shallow recession, something like that, not that deep. But anyway, I think it's more like art than science, how you manage such a soft landing. Because recently you do see the CPI data, they show some signals of the rebound, at least not slow down as people expected. So it's very hard. It's a test to the entire economy, test to policymakers. So we need to be careful, I like to say. Yeah.
Is the oil market, is that a risk to the economy? We're seeing oil now, above $90. A lot of analysts saying it's heading for $100. How big a problem is that to the outlook?
Yes, I think this energy prices is one concern. So that's why this could. But remember, the last 2 years ago, the inflation, they start with this energy price coming up, right? So that's why I'm not that confident that the U.S. must have this soft landing. In addition to this energy price, I think the strike in United States, because in 1970s, it is the trade unions, they boost this inflation for a longer time. So we don't know, but of course now the trade union, they are not as powerful as before, but still, if the car makers, they have this kind of the strike problem, that could affect to other sectors. But as I said, there's still risks there, right? From the energy price, from these strike things. So that's why I say it's still too early to see they will achieve this soft landing.
Alex, those two risks that Shark mentioned, high oil prices, maybe oil prices at $100 a barrel, and also the strike at the US automakers. Those three automakers are about half of the US car output in a year. If there was a prolonged strike there, are those two things risks for the outlook?
I think, of course, you have to assess the risk, but this time different in the commodity markets because oil seems to be heading up on its own on supply issues rather than other things. Because if you look at other commodities like metals or agricultural products, actually overall they are not doing too much recently. So I think the overall speculation in the commodity market actually is not too much. So oil probably may be just holding up on the supply issues. So this is the impact may be limited. And for the strike, I think of course that is another issue to address. But the recent unemployment data from the US show that actually more people are getting out to find jobs. So I think that probably help to ease the problems in other parts of the economy in the labor supply issue.
And of course, we got the Fed meeting this week. We'll get the decision in the early hours of Thursday morning. I guess rather than trying to guess what the Fed does, although the market's clearly expecting them to be on hold, what's going to be interesting is we'll get the dot plots again this time. So I think the key thing there is does the Fed members, do they see another rate hike before the end of the year? And also, what are they penciling in for next year in terms of rate cuts? This is, Shark, where it's going to start getting interesting, isn't it?
Yes, definitely. I think the market expect they're now going to hike interest in September, but there's maybe some small chance they will hike interest rate in the rest of the year. So our expectation is they're not going to hike interest rate this year and the next year. So to us, this kind of the tightening cycle already come to an end. But the problem is how long they will stay there. So now the tightening risks more reflect on this higher for longer scenarios. If they stay the high interest rate levels as now for longer time, I think that could be enough to have some negative impact on the economy, on several sectors like property sector. Okay, yeah.
Okay, Alex. Finally, let me get your thoughts on Hong Kong markets, as we always do on a Monday. You've been very consistent over the last few weeks. You haven't been that optimistic, and rightly so. Although you have suggested that there might be certain sectors that could outperform, but at the moment, the Hang Seng Index is the worst performer out of 92 global equity markets. Shanghai is not much further behind it, is negative, whereas most of the other markets around the world are in positive territory. Anything at all to turn you optimistic that you're seeing or could see on the horizon?
No, I don't think so. I think probably may not be too bad. I think we probably may see renewed interest in HSBC. Actually, we are already seeing renewed interest in HSBC. And that may help to support the index a little bit. And we probably may still see money inflows into defensive sectors like oil and telecoms. So basically, 5 or 6 blue chips may still remain strong, and that will limit the downside in Hong Kong. Consumption sector actually should be interesting because we are seeing better retail sales figures, and I think that one probably may worth looking right now. However, I don't think the property sector would have too much to recover. So overall, I think the old economy parks is still bad. And then also I think we are very disappointed about the reaction of the tech sectors last week, especially on Friday. They are still edging lower after the data, even though we are in the FTSE reshuffle last Friday. That may affect a little bit on the share performance, but I think the overall performance on the tech sector is still too bad. So I think people are still very concerned about the long-term outlook and the government stance toward private sector. So I think that will limit the upside in Hong Kong. So basically we probably may still have less than 10 blue chips to outperform the market, and then that will help to limit the downside. But probably that means that we are stuck within a narrow range in the Hang Seng Index, because the old economy sector like property and banks in China would still underperform, and then the tech sector will still underperform. So we do not have too much upside.
What about utilities? That's a traditional defensive sector, isn't it? We saw a big outperformance in utilities in the US over the last sort of week or so, which is sort of a signal almost of risk off. What about out here? Are utilities, are they something that you would look at?
No, because first of all, Hong Kong economy is shrinking. And then the higher yields actually also affect the values of utilities. And basically, I think people are getting hurt too much on utilities over the last few years. Many people used to hold on to Hong Kong Ye and CLP or China Gas. Actually, they lost probably 30 to 40% already. So I don't think confidence would come back easily on that sector. So I think people would prefer China Telecom sectors and oil as defensive choices. And if they want to get yields, I think they also probably may prefer HSBC than other parks, because HSBC is more globally diversified. So I think this one probably may be the one to go. Yeah.
So it sounds like from what you're saying, maybe for the last quarter, we shouldn't get too excited for the local markets. Maybe not much more downside, but not an awful lot either on the upside.
I think you probably have to look at another angle at Hong Kong. I just create a new index, just one share of China Mobile plus one share of HSBC and plus 5 shares of CNOOC. Then you have equal weights on the 3 best blue chips in Hong Kong. Then probably you think Hong Kong is in a bull market right now.
Okay, we'll call this the Alex Wong Index, Hong Kong Index. We'll start tracking it. Thank you both very much. Great to hear your thoughts there. You heard Alex Wong, who's director of Alex KY Wong Asset Management, and Lashar, who is Asia Chief Economist from BBVA. I'm joined now by Andy Sher, who is a Shanghai-based independent economist. Morning, Andy.
Good morning, Peter.
Now, we had a lot of activity data out on Friday, didn't we? Let me get your thoughts overall, first of all, on that data. I mean, maybe the standouts were that retail sales and industrial production grew faster than expected in August, but things related to the property sector weren't so good. What's your overall thoughts? Are you seeing signs that maybe the economy on the mainland is turning a corner?
Well, I think the exports are kind of bottoming out, and the export recession, it's related to global trade recession, is driven by inventory correction and over purchases of electronics during the pandemic. It seems like it's bottoming out, and also Chinese car exports are increasing at 70%. That seems to be a big factor in the industrial production number. So, but I think that's the only significant news I can see. Everything else seems like still, struggling, and retail sales might rise a little, but I do not see a strong direction there.
Well, also the other thing that was noticeable in the data was how much state-owned companies seem to be outperforming private companies on the industrial production side. Output increased 5.2% at state-owned enterprises, but only 3.4% at private companies. Presumably, we need to see this broadening out, don't we? If the economy is going to stabilise and rebound on any sort of sustained basis, we need better performance from private companies.
Yeah, but private companies are much more linked to the property sector than the state-owned enterprises. State-owned enterprises are more linked to the infrastructure sector. That has a bit more stability. I think that there are worries that the state-owned enterprises are taking up a big share of the economy. But what I can tell is that state-owned enterprises they do not employ lots and lots of people, and they tend to contract out workers. So it's temporary phenomenon, and still a private company is struggling because the property sector is struggling, and they need to expand. They need to expand into other areas.
And what do you make of the data that we saw on the property sector? Investment in the real estate sector decreased 8.8% year on year. It looks like, if anything, the problems in the real estate sector are getting worse.
Yeah, it's a gradual adjustment. China's property sector is adjusting actually slowly, even though a lot of people are complaining why it's so bad. But usually property sector adjustment is very abrupt, like in 2008 in the United States, or 1997, 1998 in Hong Kong and in Korea and Southeast Asia. So what's going on in China is that they are keeping interest rate very low. And they are not forcing bankruptcies, liquidation, and so forth. That's why it's adjusting relatively slowly. The other side is that it takes much longer to complete the adjustment, so probably many years. So that is why I think that the people who are anxious about the property sector not being good, the bad news is that it's going to be like this for a long time.
And the problem is, of course, although the government's not forcing these companies into bankruptcy, we're seeing the problem spread, aren't we? Sino-Ocean, another firm that's now talking about not being able to repay its US dollar bonds, suspending payments on them. Although these companies are somehow muddling through, they're a bit like the living dead, aren't they? They can't finance themselves.
Yeah, it is.
They can't sell anything.
It is. Yeah. That Chinese property sector is kind of similar to the Japan's property sector in the 1990s. And in Japan, the banks didn't close on the property developers. And here, I think that we have a much bigger inventory problem than in Japan because so much is under construction. So and we know that in a property cycle, it's very hard to say they are good guys, they are bad guys. These companies manage well during the boom, and so they will survive. Usually, they're all going down. So the market's view in the last couple of years, since Evergrande went in trouble, somehow trying to look for companies that were in better shape, and therefore you could bet on them, like buying discounted bonds or lending more to them, because there's so many these shadow bank lenders based in Hong Kong or elsewhere. So they always they want to do business. So they're hoping that some are good, but unfortunately, the odds are pretty low that many will survive, and they just like you said, the living dead.
And of course, if you've got firms like Country Garden, which is one of the biggest, it looks, they somehow managed to reschedule their bonds, but they can't keep on doing this, can they? Eventually, bondholders are going to run out of patience.
Well, unfortunately, bondholders have no rights. So this rescheduling, extension, the kind of thing will be with us for a long time, for years. You're going to have government interventions, like in Guangdong, the government will help out and do coordination. So creditors have to accept extension.
What do you make of the stimulus measures the PBOC has done over the last few days? They cut the RRR requirement by 25 basis points. Then on Friday, they left the MLF rate unchanged, although then they did go and cut a 14-day reverse repo rate. What are they trying to do here?
Oh, well, first, these moves are relatively small, and Chinese interests are very low. So they, in my view, they are much more for perception purposes that the government is stimulating. We need to keep in mind that anybody who can borrow, they can. There is no liquidity shortage in China's system. So and interest rate is very low. So the issue is that a lot of companies that are desperate for liquidity, they already have too much debt.
Right.
So if we want to lend to them, it's basically back to the same old treadmill of debt piling on debt. Now, how do you keep this game going? You let the land price rise so that somehow it looks like they have more equity for more debt. So that's been the Ponzi scheme for a long time. So as long as you do not get back to these treadmill, a lot of companies just simply cannot borrow at any interest rate. So what I see is that kind of tweaking the monetary policies here and there is not going to change the overall direction, but it does change the sentiment for a few days. You do see a bounce in the stock market.
But the investors seem to be able to see through it, because we get these rallies, don't we? And then they run out of steam fairly quickly. In fact, on Friday, the Chinese markets didn't even rally at all after that economic data. They still fell. So investors seem to be seeing through this. They seem to realise that it's all about perception. They're trying to give the impression they're doing something without actually doing an awful lot.
Yeah, I think the issue is the big judgment is that the government is letting the property sector go. Okay, because that if you keep it going, you create a bigger problem for you, and you just would not be able to handle that. I think that's the big judgment from so investors have to understand that. So China has to go through this. Let the property sector go, and it will become a normal, like in other countries, that does not depend on investment purchases, does not depend on rising land price. Okay, it needs to stand on its own.
But that's going to cause a lot of pain, isn't it? If the government does that, then there's going to be some major bankruptcies and some major losses. But you're saying presumably that's the best way. Let's get that pain out of the way.
Yeah, I think so. I think that the government feels comfortable in terms of from the political perspective, because the government kind of does not feel insecure in that regard. So if the economy is poor for a couple of years or even 3 years, it's something that can be handled. It's not like before.
Do you think that if they do that we also need some fiscal stimulus, though, not just this monetary stimulus? We need some fiscal policies that are going to help support the economy while it goes through that pain, because there are going to be a lot of people hurt, aren't there? A lot of consumers, a lot of people are going to lose their jobs. There's going to need to be some measures, aren't there, to try and stabilise the economy?
Yeah, the government should have cut income taxes. The top rate 45% is kicks in very early. So that's something that the government can do. But I doubt that they will do it, because there's kind of this political wind against too much money, that kind of thing. So I doubt it. That is the most effective policy in my view. Or you can cut value-added taxes, but it would be wrong for the government to spend more money. The government is already spend a lot of money. And it would be wrong to just to transfer money to governments in poor little cities, because you're going to sustain unsustainable structures there. Now, they don't have the population, they don't have the economy to support such large expenses. They benefit from these land sales and expanded their governments tremendously. So the government needs to shrink them and make them more sustainable. So structural reforms, the number one priority is structural reform. So you're going to have a healthy growth cycle coming after this. If you waste the money, if you prop up unsustainable stuff like government, extended government all over the country, then the economy cannot recover really healthily.
But presumably the government, it doesn't have to put the money into the pockets of the local authorities, the local governments. It could go and put some money into the pockets of consumers. But President Xi Jinping doesn't seem to like that, does he? He calls it welfareism and doesn't really like the idea of giving consumers more money to spend.
Well, I think some helicopter money is not going to happen. Okay, they didn't do it during the pandemic, so not likely to do it now. So I think the issue is cutting taxes. What are the government be willing to do that? But I think politically, it's unlikely. The government's priority is not the economy; it's a geopolitical competition. How to get China to become self-reliant in technology. That's the number one priority. So the government is throwing money at technology startups like crazy, right? So if the government wastes some money there, it's okay. They don't mind. As long as somehow solutions are found.
Let me finally just get your thoughts on this dispute over electric vehicles between the EU and China. The EU accusing China of subsidising its EV manufacturers and flooding the European markets with cars. What are your thoughts on this? You mentioned earlier in the segment about how big an impact that's had on industrial production. It's really sort of EV sales that are driving the economy at the moment.
Yeah, the problem is that the European car companies are not making EVs, and the Chinese car companies are making EVs, and consumers want to buy EVs. This is number one thing, all right? The second is that the treatment, like a low land cost and some tax breaks for high-tech companies, everybody gets it, including Volkswagen. Or obviously Tesla, right? So it's the same treatment. It's not like they're singling out some private Chinese companies like BYD or Geely for tax breaks. That is it's not like in Europe they give a special treatment to BAE, Airbus, and so forth, right? So, but this is not the EV sector here. But the issue, the issue is that I think that Europe is in a big trouble. European companies are stagnant in technology, and they have high cost, so they are under a lot of pressure. And so I think they're not competitive, and it's not easy to turn them around. So you want to go to policy to keep them alive, but the issue is that it's not so easy. European car companies are selling like 5 million or 6 million cars in China. If you don't let the Chinese cars go to Europe, and then European cars cannot sell in China. So I don't think that Europe has the upper hand in that regard. So this thing is going to go on.
Okay, Andy. Well, it's great to hear your thoughts on all of that. Thank you very much indeed. That's Andy Scher, who is a Shanghai-based independence economist.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Alicia Garcia Herrero, Chief Economist for Asia Pacific at Natixis, and our US economics correspondent, writer and broadcaster, Barry Wood. Bye for now.
Money Talk.